Welcome back to the deep dive. Today, we're tackling something pretty fundamental for anyone looking at property investing. It's that big question. Residential real estate, single-family homes, small rentals, versus commercial real estate, CRE, office buildings, retail, industrial parks.
Yeah, it's a huge fork in the road. A lot of people start residential. It feels more familiar maybe.
Mm.
But commercial, wow, that's a different league. Different scale, different money involved, different headaches too, frankly.
Exactly. And it's not just about the size of the building, is it?
Sure.
The sources we looked at really drill down into how different the whole structure is, the economics, how you get financing, how you manage the thing day to day.
Completely distinct. So I think our goal today in this deep dive is really to pull out those key insights from the investors who've done both. We want to lay out, how residential or RRE often leans on your own effort, your sweat equity, and some smart tax plays.
Right.
And then contrast that with CRE, which demands, well, frankly, much deeper pockets, a whole different level of financial scrutiny, and knowing your way around complex leases and asset types.
Okay, so the idea is to help you, the listener, figure out which path really lines up with where you are now, your resources, and I guess where you want to end up.
Exactly, aligning your strategy with the reality of each path.
All right, let's unpack this then. Before we even get to the spreadsheets, what's the big difference in just the skills you need, the level of commitment? Because one source really hammered home that residential investing, at least if you're active about it, it's basically a job. It's not passive income from day one.
That's probably the first mental hurdle people need to clear. RRE, if you're really doing it to build wealth, it is a working business. It's not like buying some stocks or a 401k where you just, park your money. Success in RRE means putting in serious human capital. That's your time, learning the ropes, finding deals, figuring out funding, managing tenants, fixing things. It's active. If you want that portfolio growth that, say, beats the market averages, you have to be prepared to actually do the work.
So even if the end game is passive income down the line, you've got to actively build the machine first. And it sounds like the absolute bedrock of that machine is finding what they call great deals.
The sources kept saying the successful RRE investor isn't just buying property, they're a problem solver.
Precisely. That's the mindset shift. You're hunting for the motivated seller, someone in a bit of a tight spot, maybe. Maybe their listing expired, sat on the market too long, or maybe they're facing something more serious like foreclosure.
Okay, but here's something that jumped out at me from the reading. One source really emphasized maintaining the seller's dignity, especially if they're in a tough situation like foreclosure. That feels a bit counterintuitive if you're trying to get the lowest price, right? It does seem that way at first glance, doesn't it? You think, okay, they're desperate, time's short, let's push hard. But the source argued pretty convincingly, I thought, that going in with that cold take it or leave it offer, you just become another problem for them, another predator.
Okay.
And you kill any chance of working with them. But if you approach it like, okay, how can we solve this together? How can I help you get out of this situation? Maybe even keep your credit intact, preserve some dignity. You build trust.
And that trust leads to...
It can lead to a much smoother deal. More importantly, it might make the seller willing to agree to creative terms, like maybe carrying some financing themselves, which they might just flat out refuse if they feel cornered or antagonized. It's that softer approach that can actually unlock a more profitable, more structured deal in the end.
Yeah, interesting.
Yeah.
Okay, so you find the deal, you handle the seller right, now you need the money. Especially if it's a fixer-upper. Because the sources say traditional banks often get nervous about properties needing a lot of work. This is where creative financing comes in.
Absolutely. And the big theme here was stability. Prioritize long-term loans. Always.
Why is that so critical?
Simple math, really. A longer loan term, say 30 years instead of 5 or 10, means lower monthly payments. Right away, your investment is safer because you've got more cushion, more cash flow margin between the rent coming in and the mortgage going out.
Makes sense.
You have to be really careful, aggressive even, about avoiding those short-term loans, the kind that ballooned in 5 years, forcing you to sell or even worse, refinance when rates might have shot up. That kind of instability can just crush your return.
Right, you could lose everything you've gained. And if the bank says no or the terms just aren't great, the sources talked a lot about getting the seller to act as the bank, seller financing or a trust deed. How does that actually work? Why would a seller go for that?
It's a fantastic tool, especially when banks are tight. Basically, you, the buyer, put down a certain amount and the seller agrees to carry the rest of the debt. You make monthly payments directly to them, usually over many years. Now, you might agree to pay a slightly higher purchase price than if you got a bank loan,
Okay.
but in return, you get much easier qualification terms. The real magic, though, is often on the seller's side.
They get a decent interest rate, better than a CD or something?
That's part of it, yeah. Maybe they get 6, 7, 8% instead of, next to nothing in the bank. But often the real driver is taxes, especially if they've owned that property for a long, long time.
Capital gains.
Huge capital gains sometimes. If they sell outright, boom, big tax bill. But if they structure it as an installment sale using that seller mortgage, they can spread that capital gains tax liability out over 10, 15, 20 years. It smooths out their tax hit, and it turns their property problem into a steady, long-term income stream for them. It's a win-win, often.
Wow. Okay, so you're essentially using the seller's own tax situation to help finance your purchase.
Yeah.
Yeah, it's pretty clever. All right, let's talk about the property itself, the classic fixer-upper, building sweat equity. But the sources seemed a bit cautious here, warning against taking on too much work.
Yeah, that's a really key distinction. The sweet spot, according to the materials, is a property that needs just a little work, not the total gut job you see on TV sometimes.
Why not the big rehab? Isn't that where the big profit is?
The math can be brutal. If you have to pour massive amounts of cash into a place, new foundation, roof, wiring, plumbing, everything, your initial investment is huge. That means it takes way longer just to get your money back out, let alone turn a profit. You want the cosmetic stuff, maybe some contained structural fixes that give you the biggest bang for your buck in terms of forced appreciation without tying up your capital forever.
And location, location, location still applies, even if it needs work.
Oh, absolutely. Non-negotiable. The ideal fixer-upper is always in a neighborhood where most people own their homes and, take care of them. Good curb appeal around you. That protects your investment and makes it much easier to sell later at a good retail price because you're benefiting from the stability and pride of ownership all around you.
Got it. So finding these deals, it really is about using your knowledge, your effort,
Yeah.
your human capital, as you said, to attract the financial capital. Once you've got that down, the next stage is scaling up, building a portfolio. And that leads us straight into that famous acronym, BRRRR.
Ah, yes, BRRRR, buy, rehab, rent, refinance, repeat. It's kind of the engine for really accelerating your growth in residential because it's all about recycling your capital.
Okay, break it down. The buy stage.
That's step one, obviously. You got to find that great deal. We talked about good location, needs work, bought below market value. And often you're funding this initial purchase with short-term money, maybe cash if you have it, or a partner, or often a hard money lender.
Why short-term or hard money? Why not a regular bank loan right away?
Because, as we mentioned, traditional banks tend to shy away from properties that are, well, the sources call them nasty properties. They want move-in ready collateral, usually. Hard money lenders specialize in these riskier short-term loans for rehab projects, but they charge a premium for it.
Right. Hard money means higher interest rates, shorter terms.
Hmm.
Sounds risky. What if the rehab takes longer or costs more than you planned?
That is absolutely the risk. The BRRR strategy lives and dies by speed and accuracy. Your budget has to be tight, your timeline realistic. If that rehab drags on, those high, hard money interest payments can just eat up your entire potential profit.
Ouch.
But honestly, the place where it often breaks down is the refinance stage. After you've fixed it up and rented it out, you go to a traditional bank for a long-term mortgage. The bank sends an appraiser.
And if that appraisal comes in low?
If it comes in lower than you need, you might not be able to pull out all the cash you originally put in, plus the rehab costs, and that shatters the repeat part of the cycle. You're stuck. The whole model hinges on forcing enough value increase through the rehab to hit that target appraisal number for the refinance.
Okay, so high risk, high reward maybe.
Yeah.
But when it works, the tax side of that refinance step sounds amazing. The sources highlighted that the cash you pull out in a refinance is generally tax-free.
That's the beautiful part. It's brilliant, really. When you sell a property, you pay capital gains tax plus sales commissions, right? Actually 15, 20% tax, maybe 6% commission. That eats into your profit significantly.
Yeah.
But when you refinance, you're just taking out a loan against the increased value. Loan proceeds aren't considered income, so no immediate tax hit. One analysis we saw actually showed that after taxes and commissions on a sale, you might actually walk away with more cash in your pocket from a refinance than from selling. And the best part, you still own the asset, it's still appreciating, still generating rent every month. You're basically getting paid to keep the property and leverage it further. It's powerful stuff.
Okay, so you get the BRRRR engine humming, you're recycling capital, But now you've got multiple properties, multiple rehabs, multiple tenants. You can't do it all yourself if you want to scale. You need leverage, but not just financial leverage. You need people, a team.
Non-negotiable if you want to grow beyond just a couple of properties. The sources talk about the core four.
Yeah.
You absolutely need these people.
The core four. Let's see, agent, lender, property manager, and the rehabber or contractor.
That's them. Your real estate agent finds the deals. Your lender handles the financing, both short-term and long-term. Your property manager deals with tenants and day-to-day issues. And your contractor handles the rehabs reliably and cost-effectively.
And the key relationship here, the sources said, is volume. You bring them consistent business.
Exactly. That's your leverage with them. They need your deal flow just as much as you need their expertise. It's symbiotic. Think about the contractor, for instance.
Right, the sources compared it to the Costco model.
Yeah, it's a great analogy. If you're just giving a contractor one random job a year, they need to maximize their profit on that single job. But if you're bringing them, say, 4 or 5 rehabs consistently year after year, they know they have steady work from you.
So they could afford to take a smaller profit margin on each individual job.
Precisely. They get a smaller slice, but they get way more pies guaranteed. So you negotiate lower construction costs based on that volume. It makes your rehabs cheaper, boosts your profit, makes the whole BRRR cycle spin faster and more reliably. It's about building those win-win relationships.
Makes total sense. Okay, let's shift gears slightly to long-term wealth protection within RRE. Taxes again. Depreciation came up a lot. It sounds almost like magic, but how does it actually work to save you money?
It's probably the biggest tax advantage in real estate investing. Depreciation lets you deduct a portion of the building's value, not the land, from your rental income each year, supposedly to account for wear and tear, even if the property is actually going up in market value.
Okay.
For residential property, the IRS says you depreciate it over 27.5 years. So let's say you buy a rental for $300,000. Maybe the land is worth $50,000. You can't depreciate land. So you depreciate the $250,000 building value over 27.5 years. That's about $9,090 a year you can deduct.
And that deduction can often create a loss on paper, right? Even if the property is actually making money month to month.
Exactly. Your rental income might be $20,000, your cash expense is $15,000, so you have $5,000 positive cash flow. But then you deduct that $9,090 in depreciation, and suddenly on your tax return, you show a $4,090 loss.
Okay, so you have a paper loss. Can you use that loss to reduce taxes on your other income, like, say, your regular job salary?
Now we get into the tricky part. Yes, you potentially can, but there are big limitations. These are generally called passive activity losses.
Right, the $25,000 limit I've heard about.
That's the one. If your adjusted gross income, your AGI, is under $100,000, you can usually deduct up to $25,000 of these passive rental losses against your non-passive income, like your W-2 salary. That's a huge tax break for many middle-income investors.
What happens if you make more than $100,000?
It phases out quickly. For every dollar your AGI is over $100,000, that $25,000 allowance gets reduced by 50 cents. So once your AGI hits $150,000, poof, the allowance is completely gone.
So if you're a doctor, lawyer, successful business owner making good money, those paper losses from your rentals generally can't offset your main income anymore?
Not unless you qualify for a special status. It's called being a real estate professional in the eyes of the IRS.
And that's not just about having a real estate license, right? The sources were clear on that.
Definitely not. It's much tougher. You have to meet 2 strict tests based on your time. First, more than half of all the personal services you perform in all your jobs or businesses during the year have to be in real estate trades or businesses developing, construction, management, brokerage, etc.
Okay, half your work time?
And second, you have to spend more than 750 hours during that year working in those real estate activities.
Wow, 750 hours is significant. That's like a part-time job.
It is. It's a high bar. But if you meet both those tests, the IRS no longer considers your rental activities passive. And then those rental losses, including depreciation, can be used to offset almost any other income you have, your salary, business income, interest, dividends, whatever. It's a massive advantage for high-income earners who are seriously committed to real estate.
Okay, that makes sense. It's a path, but a demanding one.
Yeah.
Now, let's talk about graduating, maybe from RRE to CRE. Commercial real estate feels like a completely different world.
It really is a major shift. Often, investors make that jump when maybe the opportunities in single-family homes start drying up in their market, like the source mentioned with the investor who pivoted from foreclosures to fiveplexes, and then that big 56-unit condo complex. You build capital, you build a team, you start looking for bigger deals.
The scale is definitely appealing. But the sources were very clear. The barriers to entry for CRE are formidable, much, much higher than RRE. And it sounds like the financing is where things get really, really interesting and tough.
That's often the make or break point, absolutely. CRE lending operates under totally different rules. Forget putting 20% down like on a house.
So what are these unforgiving demands you mentioned?
Well, first off, your personal net worth. Lenders don't just look at the property's value, they look hard at you. They often require your personal net worth to be equal to or even greater than the total loan amount you're asking for.
Wait, equal to the loan amount. So if you want a $5 million loan, you need a $5 million net worth.
Minimum. And we saw examples where they wanted 2 times the loan amount in net worth. They want to know you have serious financial reserves, deep pockets that can weather storms, vacancies, market downturns without you defaulting on their loan. It's about your overall financial strength, not just the property.
Wow. Okay, so it's not just about the property, it's about your entire financial picture.
Exactly. And that leads right into the second big hurdle, what they call global cash flow analysis.
Global cash flow, what's that?
When you apply for a commercial loan, they don't just underwrite the deal in front of them. They demand your full schedule of all the real estate you already own, your REO schedule. They analyze the income and expenses from your entire existing portfolio.
Why do they care about your other properties?
They want to see if your whole real estate operation, globally, generates enough cash flow to support all your debts, including the new one you want to take on. They stress test it. What if vacancy spikes in one of your older buildings? Does the whole ship still stay afloat? Can the profitable properties carry the weaker ones temporarily? They're assessing the health of your entire real estate business, not just one property.
It's a much more holistic and, frankly, tougher underwriting process. And the sources also made a point about just how you present yourself, that commercial loan officers don't suffer fools gladly.
Yeah, that's putting it mildly. Professionalism is absolutely key. These loan officers are used to dealing with sophisticated business borrowers. You need to have your financials organized, your business plan clear. You need to sound like you know exactly what you're doing.
No winging it.
Definitely no winging it. And another really critical piece of advice from the sources was about mortgage brokers. If you use a commercial mortgage broker to help find financing, pick one good one and stick with them for that deal.
Why? Why not shop it around to multiple brokers to see who gets the best deal?
Because in the commercial world, that's seen as a huge red flag. If lenders start seeing the same deal pitched by 3 different brokers, they immediately think the deal is being shopped to death. Meaning either the borrower is desperate or there's something wrong with the property that's making it hard to finance and everyone's passing on it. Lenders lose interest immediately. They won't waste their time on a deal that looks like damaged goods. You pick one broker you trust and let them run with it exclusively.
Okay, good practical advice there. Now, thinking about the types of CRE assets, office, industrial, retail, the potential scale of value creation is just enormous compared to RRE. That example of the 25-story office building transformation was pretty mind-blowing.
Yeah, that really shows the potential, doesn't it? Bought for $180 million, which is already a huge number. But the investors didn't just sit back. They did a massive overhaul, specifically mentioned putting on a whole new modern facade. That wasn't just cosmetic. It likely improved energy efficiency, tenant appeal, everything. It repositioned the asset.
From dowdy to Class A.
Exactly. And that vision, that significant capital investment, allowed them to eventually sell it for, what was it, an estimated $1 billion. That's creating value on a massive scale. That's the CRE game at its highest level.
Within that office world, though, there's this niche of speculative development. Building without tenants already lined up. That seems incredibly risky, especially given what you said about financing.
Oh, it's hugely risky. Building spec office space, especially in a super expensive market like Manhattan, is very rare. The land costs, construction costs, they're astronomical.
Wow.
Getting financing without a major blue chip tenant already signed to a long lease is almost impossible. It's a massive gamble on future demand.
But then the sources mentioned something interesting. Sometimes investors pay a premium for an existing office building that has a lot of vacant space. That seems backwards. Why pay more for emptiness?
It does sound weird, right? But it's a strategic bet. It's all about timing and resetting rents. If you buy a fully leased building, but the existing tenants signed their leases years ago, they might be paying well below current market rates. You're stuck with that lower income until those leases expire.
Okay.
But if you buy a building with significant vacancy, and you believe market rents are high and going higher, that vacancy is actually an opportunity. You can immediately lease up that empty space at today's top dollar rates. You're not weighed down by old, cheap leases, so you might pay a premium for the potential to quickly maximize the building's income at current market levels. It's a bet on capturing that upside immediately.
Gotcha. It's about the potential for immediate revenue growth. Okay, final big area of contrast. Managing the property and structuring the income through leases. RE management seems focused on individuals, screening, keeping tenants happy and stable. CRE is dealing with businesses, often with much more complex lease agreements.
Totally different focus. In RE, like we touched on, stability is everything. Tenant turnover is your biggest killer expense. The vacancy, the cleaning, the repairs, the marketing to find someone new. It all adds up fast. So the smart landlord focuses on finding tenants likely to stay long-term, 2, 3, 5 years or more.
And they use screening for that, asking about how long they stayed at previous places.
Exactly. Past behavior is a good predictor. And once you have tenants, the management philosophy has to be rock-solid consistency, especially on policies.
Right, the sources are really tricked about that. Never discriminate. Treat everyone equally, and don't bend the rules on late rent.
Absolutely critical. Fair housing laws aside, which are paramount, bending the rules, say, on late fees just once, the source warned that exception immediately becomes the rule for that tenant, and maybe others if they find out. It completely undermines your ability to enforce the lease later. You have to be firm, fair, and utterly consistent.
And I thought that point about shifting minor repair costs to tenants was interesting. Things like clogged toilets. Is that becoming more common in RRE?
It seems to be a trend, yeah. It serves two purposes. One, obviously, it saves the landlord direct costs on those small, often tenant-caused issues. But maybe more importantly, it changes tenant behavior. If the tenant knows they have to pay the plumber if they clog the disposal with coffee grounds, they tend to be a lot more careful with the property. It encourages responsibility and reduces those annoying, unscheduled maintenance calls.
Makes sense. Now let's flip to CRE leases. This is where the income structure gets really sophisticated, right? The leases themselves are designed to grow the income over time.
Yes, this is a fundamental advantage of commercial properties. The leases often have built-in mechanisms for revenue growth beyond just collecting the base rent. There are three main ways this happens.
Okay, what's the first?
Percentage rents. You see this a lot in retail leases. The tenant pays a base minimum rent, but the lease also says if their store's sales go above a certain level, say $5 million a year, the landlord gets a percentage, maybe 3%, of all the sales over that threshold.
Wow, so the landlord actually gets a cut of the tenant's business success.
Exactly. It aligns the landlord's interests with the tenant's success. If the store does really well, the landlord shares in that upside. It provides automatic growth potential tied to the tenant's performance, and it acts as an inflation hedge, too. And the sources mentioned this isn't just retail anymore, it's popping up in other areas like specialized healthcare leases sometimes.
Fascinating. Okay, what are the other two mechanisms? They sounded a bit more straightforward.
They are. Second is just simple rent bumps or escalations. The lease just spells out predetermined rent increases at set intervals. Maybe it goes up 2% or 3% every single year of the long-term lease. It's predictable, built-in growth.
Got it.
And the third, which is hugely important in the CRE, is expense sharing or recovery. This is often structured as a triple net or NNN lease, though there are variations. Essentially, the tenant pays not just rent, but also their pro rata share of the property's major operating expenses, property taxes, insurance, and common area maintenance.
So the landlord's exposure to rising costs is much lower.
Dramatically lower. Unlike in most residential leases where the landlord pays taxes and insurance, in many CRE leases, those costs are passed through directly to the tenants. This makes the landlord's net income much more stable and predictable, insulated from unexpected jumps in operating expenses.
That's a huge difference in risk profile. Okay, last point. Connecting all this back to the bigger picture of cities and how property use is changing, we're seeing this massive shift, this inversion of use, as the sources called it.
Yeah, it's really striking in some big cities. The example given was downtown New York, particularly the south end of Wall Street, historically the heart of finance, right? But now, the sources say every single building there has been converted to either residential apartments or hotels. The demand for living space has overtaken the demand for office space in that specific area. It shows how dynamic cities are and how property use has to adapt.
But that adaptation, especially when you have these huge CRE players trying to convert or reprice assets with existing residential tenants, that can lead to major conflict. That Stuyvesant Town Peter Cooper Village story was a cautionary tale.
Oh, absolutely. A classic and painful example of when CRE ambitions collide head-on with RRE realities. You had this massive housing complex in Manhattan, thousands of rent-stabilized apartments, a huge CRE firm bought it for billions, loaded up with debt.
And their whole plan
Hinged almost entirely, according to the sources, on being able to rapidly deregulate those apartments, basically, kick out the existing tenants or force them onto much higher market rate rents. That was the only way the numbers worked to pay back the enormous debt they took on.
So the investment thesis, it was basically built on displacing thousands of people.
Pretty much. And that preoccupation, as the source called it, with deregulation led to massive legal battles with tenants, huge public backlash. It became this epic struggle. The CRE investors, driven by their debt load, versus the RRE tenant class, fighting to stay in their homes.
And it didn't end well for the investors, did it?
No, the combination of the legal challenges, the 2008 financial crisis hitting, and the sheer weight of the debt, the whole thing collapsed into default. It's a stark reminder of the risks when your CRE profit model depends entirely on aggressively monetizing or displacing an existing residential base. The two worlds can clash spectacularly.
Wow. Okay, so wrapping this all up, what's the big takeaway here? There's two very different paths.
I think the core distinction is clear. Residential, RRE, it's often a path you can start with less capital, but it demands more of your time, your knowledge, your direct effort, finding deals, managing, using strategies like BRRR, leveraging those tax breaks like depreciation, and the 25K loss allowance. If you qualify, it's active.
Right. Hand on.
Then you have commercial, CRE. It's the PAP scale, potentially much larger returns, more passive income through things like NNN leases. But the entry fee is massive capital, navigating incredibly demanding lenders who scrutinize your global finances and needing real expertise in complex asset types and lease structures. It's a high-stakes, professionalized game.
So it really comes down to aligning your personal resources, time versus capital, and your tolerance for complexity and risk with the demands of each path.
Exactly. But maybe we can leave our listeners with one final thought to chew on, connecting this back to long-term investing principles.
Okay.
We know from decades of market data, right, that if you hold a diversified portfolio of common stocks for a really long time, say 25 years, the variability smooths out, and you tend to get a pretty reliable, generous average return historically, a bit over 10% a year. That's sort of the benchmark for long-term, relatively certain growth.
Certainty over the long haul.
Now, real estate has its own unique long-term superpower, especially on the tax side, the 1031 exchange. As long as you follow the rules and roll your sales proceeds into a like-kind replacement property, you can defer paying capital gains tax, potentially forever. You can trade up from a duplex to a fourplex to an apartment building to a shopping center, growing your wealth tax deferred, maybe even across generations.
Okay, indefinite tax deferral. That's powerful.
So here's the question to ponder. Given the long-term return certainty offered by stocks and the potentially infinite tax deferral offered by real estate exchanges, where should your focus be? Are you optimizing for the immediate cash flow and active management challenges of building an RRE portfolio using methods like BRRRR? Or are you thinking bigger, longer term, about how to strategically position yourself, perhaps moving towards CRE eventually, to fully capitalize on those generational tax advantages that continuous 1031 exchanging offers? It's about prioritizing immediate gains versus long-term tax-efficient wealth compounding.
A very interesting strategic question to end on. Which matters more right now, and which matters more for the ultimate long game? Lots to think about there. Thanks for breaking that all down.
My pleasure. It's a fascinating comparison.